Hi friends, welcome to my channel, and in today's video we're going to see about 4 approaches of how efficiently and effectively you can use your capital and allocate them across various assets. So these 4 approaches, keep watching on and please share it to your friends and relatives so they can also get an understanding of what are these 4 approaches of which they can pick upon and decide how to effectively allocate their capital across various assets. So these 4 approaches which I'm going to talk to you about, the first approach is going to be about strategic allocation, the second one is going to be about tactical, the third going to be about core satellite approach, and the fourth is going to be about dynamic allocation. So let's see further what are each of these approaches actually signify. So the first asset allocation is the strategic asset allocation. As the name signifies, it's a cool term, a cool warrior in the financial world, wherein you want to have a cool laid back approach. You just want to buy your investments and then wait for a long duration of time. You have a high risk tolerance, and because of this high risk tolerance you have the appetite to wait for long duration. And when I say long duration, it's more than 7 years. The more than 7 years is because your financial need or your financial wealth accumulation can wait for beyond 7 years. It could be a retirement related expenses, it could be an education, it could be a marriage, whatsoever. If it has a waiting period of more than 7 years, then the most desired allocation strategy could be a strategic allocation. And in strategic allocation, you decide the percentage of allocation across equity, bond or gold, and cash. For example, you might decide based upon your age and risk tolerance, you decide whether in equity you want to do 60% allocation or slightly more or less. And then in gold or bonds, it could be about like 35, and then remaining 5% in cash. So once you have decided this strategic allocation, you then balance out this allocation on either on an annual basis or depending upon the percentage of increase in the value upon a certain period of time. For example, you might decide that if equity allocation from 60%, if it has reached 70%, then you want to balance it out by selling the 10% of the equity and buying bonds which are actually currently undervalued. So then you maintain that same asset allocation strategy. That's about asset allocation for strategic. And obviously in strategic allocation, you don't need too much thorough knowledge about the macro and the micro. Of course, you need some limited knowledge about how to understand the financial statements of companies if you're doing direct investment, or how to pick up mutual funds depending on various criteria or selection of mutual funds, whether it's direct, indirect, depending on age, depending on fund manager, depending on various other risk return ratios like Sharpe, Tanner's ratio. All this ratio will play into picture when you decide of how to select these assets, whether it's mutual fund or direct stocks. So that's about strategic asset allocation. Laid back approach, have fun, wait for a long duration of time to meet your financial need, and limited experience in the financial world. So the second one is about tactical asset allocation. As the name states, tactical. To use tactics, you need to be an expert. You need to be an expert in understanding the macroeconomics as well as microeconomics of the economy as well as the company or the specific assets, how it behaves with respect to different conditions of the macros. For example, if the interest rate might rise or decrease depending on the behavior or the pattern of the interest rate, bonds or equities or gold could respond likewise. So you need to have that thorough understanding like an expert. And because of you are an expert, you are able to rotate your portfolio more frequently. So you are a short term to a medium term investor, not a long term investor. So short term to medium term, you have this expert view, and depending on your expert view, you decide you want to change the sector from a reality sector to a chemical sector, maybe, or from FMCG sector to a chemical sector, or it could be like from oil industry to maybe gold, whatever. So you have this expertise, you have an understanding about these various asset classes, and hence you are able to rotate or churn the portfolio very frequently. So that's about tactical. You have great control about your investment. So whatever you invest, you are a master at that, and hence you have better control. And obviously you're a short term to medium term investor. So that is tactical approach for you if you're a short term to medium term and having great deal of expertise in understanding the macros as well as the micros. So now coming to the third asset allocation, which is your core satellite approach. The core satellite approach is more of a combination of strategic as well as the tactical approach. Now in strategic, in case of a core satellite approach, you decided 80% of your investment you want to do by using the strategic allocation. That means 80% of your portfolio, you decide what is the percentage of investment you want to do in equity, bonds, gold and cash, and then balance it out on a yearly basis of depending on certain percentage. If the asset grows overvalued or undervalued, you sell and buy the undervalued asset, so that you keep the same percentage for the 80% of the portfolio, and the remaining 20% of the portfolio is actually going to be your satellite portfolio. So your strategic is going to be your core portfolio, and your satellite is going to be your tactical portfolio. In this tactical portfolio, you churn your portfolio more often because you want to take advantages of specific timings in the market, specific events in the market, so that you can maximize the returns. So your alpha will increase over the benchmark return. The fourth approach is going to be your dynamic allocation. This is mostly used by institutional investors, wherein they shuffle between riskless and risky assets. So if the risky assets come with a low cost, they buy risky assets, and if the riskless assets give them a better percentage of returns, better expected percentage of return, then they will want to allocate into the riskless asset. However, this has major involvement of timing, because it requires a thorough understanding about the macros as well, whether the interest rates are going to rise or whether they're going to fall, and depending on the interest rates and the inflation factors, you want to decide whether you want to invest in the riskless and the risky asset classes. So that's about dynamic asset allocation, mostly used by institutional investors, but individual investors also use it upon their own discretion. I myself also use dynamic allocation to a certain extent along with strategic allocation. These two asset allocation strategies have helped me, because tactical allocation requires more of a churning out of portfolio, frequent selling, buying, which I am of an opinion that I just want to buy great stocks and hold them for a long duration of time, increase my risk appetite as I keep accumulating wealth, and then of course do a dynamic allocation as well, depending on whether assets are risky and less expensive at that particular point of time, so that I can buy this risky asset at a low cost by selling the riskless assets, or later on buy a riskless asset at a low cost by selling risky assets. So both this combination, dynamic as well as strategic, you could utilize to your maximum benefit to meet your financial needs and to maximize your wealth, provided you have a more risk appetite, you are willing to wait for at least more than 7 years. But if you do not have this risk appetite of waiting for more than 7 years, then ideally a tactical or a core satellite approach would be more suitable for you. So please suit your selection. Please decide for yourself based upon whatever I explained for each of these 4 approaches. And in case you still have question about these 4 approaches, please drop a note in the comment section, and I'll be glad to get back to you as soon as possible. Okay, and please do read my book. It's more about the stages which I have gone through for the past 13 years of how you can also do it for yourself to increase wealth for yourself, so that you can build this financial powerhouse, so that you can meet any financial need or any retirement need, or maybe even retire early. That's all for today. Bye.